economic recovery seems to be running out of steam, and some observers even fear a double-dip recession. We asked Giles Keating, head of Credit Suisse's global research, what his views are. Giles, are countries such as the UK and the US actually facing a double-dip recession right now?
Well, we had a big discussion about this at our Global Economics and Strategy Group meeting at the end of August. And really, I think the view was, of course, these economies are going through a bit of a slowdown. We can see that in the economic indicators, but we really don't think they're going into a double-dip recession. In fact, if you look back historically, it is really very usual 18 months into a recovery, and we've had a very good recovery over the last 18 months. It's normal to have a bit of a slowdown. It's to do with the pace, the way that the inventory cycle operates. So we really think, yes, there can be perhaps another 6 months or so where things are a bit more sluggish than they have been, but we don't think there's a double dip. We think the recovery continues.
You sound quite optimistic. So which countries or regions are outperforming right now?
Actually, at the moment, continental Europe and the UK have actually been doing a little bit better than the United States. And it's not clear whether that particular gap will continue. Probably things will equal up a bit over the next 6 months or so. I think the bigger picture is that, of course, the emerging markets are moving ahead very, very strongly, while the developed economies as a group, US, Europe, Japan, lag behind. And that, I think, is really a new part of the structural scene, which will just carry on. That's not to say that the emerging markets don't have minor cycles, and indeed it looks pretty likely that, for example, China is going to be a bit slower in coming months than it has been earlier this year. But that, I think, is just relatively minor fluctuation. Emerging markets are where the growth is.
Is a Japan-like deflation scenario an issue anywhere?
In Japan itself, we currently have a minor deflation. It doesn't look anywhere near as intense as the one that hit Japan in its lost decade at the end of the last century. I think if we look at America, if we look at continental Europe, at Switzerland, then of course inflation is standing at very, very low levels. And there is a risk that you could dip into outright deflation, at least of a minor amount. We don't think that that is anywhere near a central scenario. And one of the reasons for that is because of the economic view I've just given you. Another reason is because we think the banking system is now really beginning to return to health. For example, the last survey conducted by the Federal Reserve Board showed a very distinct improvement. And of course, the banks have been recapitalised. All of that helps reduce the risks. And the problems with the Eurozone debt, which was so concerning earlier in the year, not least because they could spill over into the banks, and then that could spill over into the real economy, and then that could create deflationary forces. That danger, for the time being, has really been, I think, ring-fenced by the Emergency Stability Fund that we have. So for all of these reasons, I think deflation is relatively unlikely. And then on top of all of that, in contrast to Japan a decade or so ago, it's clear that the authorities in the central banks in America and Europe are determined not to let it happen, and they'll just step up their bond purchases even more. And that's not a wholly easy option, but we think it would help reduce the deflation risk.
So when can we expect the global economy to pick up again?
If this historic pattern that I mentioned a few minutes ago is repeated, then we would basically go through a period of the next 6 months or so, through till around the end of this year, early in 2011, of the slightly slower growth phase. And then as we went through the first half of next year, we would see a mild re-acceleration again. And as I say, based on the way that the inventory cycle has operated in the past, that would be a fairly normal process. And that fits with the idea that you do not have major impediments from the banks and so on. Of course, some people are worried that government cutbacks, these austerity programs, are really going to stall growth out. And that's not something that myself and colleagues on the Global Economics and Strategy Group agree with. We're well aware that we are going to have some headwinds from the cutbacks in government deficits. but it's our view that those effects will be smaller rather than larger.
Do you expect the world's central banks to start raising their rates again?
At the moment, of course, we've got rates near zero in most major developed countries, and I think one should just expect that to continue for a very prolonged period. And I think investors everywhere would be well advised to position their portfolios on the basis of zero as really the norm in terms of cash returns, with an effect, of course, meaning that as you've got shorter dated, safer bonds, yields also very close to zero. We think that the likelihood of the Federal Reserve in the States raising interest rates next year is now become very low. It's possible that we could see a minor move in the Eurozone, in Switzerland, in the UK perhaps next year. But these, I think, would be smaller moves, particularly in the Eurozone. I think basically the picture next year is one of rates remaining very, very low in the major developed countries. Obviously, in emerging markets and in some of the commodity-linked developed countries such as Australia, that's a different matter. There, of course, we've already had rate rises, and quite likely we may get a little bit more.
Turning to the equities markets, the second quarter earnings results were quite good. How are the figures for the current quarter looking?
Things have come in very well, and as the season has progressed, we've seen earnings estimates being revised up by analysts, and once again, really there have been upside surprises. And that's particularly true in emerging markets. We've continued to see even more strong upward revisions in Asia, for example. Now, I suspect as we look forward from here that we're coming towards the end of that sort of round of, as it were, almost continuous upward revisions to earnings estimates. And in my view, the view of my colleagues, that's not the start of a major downturn, but it does mean that we've had the kind of white heat of adjustment upward of expectations, and from here on it's a more modest but still forward movement.
On the currency markets, the euro recently reached a new low against the Swiss franc. Will this trend continue? We
feel we're coming towards the end of the large stage of that movement. I mean, we still feel that the Swiss franc is, as it were, structurally going to perform very well, remaining one of the strongest of the major currencies over the coming months. But we certainly don't feel we're going to get further surges on the same scale that we've seen in the Swiss franc. So there may be brief bouts that take us a little bit stronger on the Swiss franc, weaker on the euro, but the larger part of that move is over for now.
How about the US dollar?
A rather similar story. I mean, we feel that the dollar-euro rate is beginning to stabilise in a range perhaps somewhere around the 124, 125 up to about 133, 134 level. At the time we're making this interview, that puts the euro towards the lower end of that band and suggests that it's got a bit of scope to move up from there. But I mean, obviously one would have to adjust that depending on the current position at the time that people are watching this.
How should investors act in this environment?
Well, essentially we feel this is a market where equities actually remain fair value. And so in a strategic sense, investors should be buying equities, particularly when we get dips and building up strategic exposure. Now, having said that, we're well aware that many investors, certainly many private investors, but indeed in some ways some institutional investors are very concerned about the uncertainty. And by the way, we don't think the uncertainties get resolved quickly. You know, we've touched on a lot of issues in this interview, and those issues are not going to become a lot clearer in coming months. So I think for those investors who are concerned by this uncertainty, we would recommend strategies that are designed to give good upside in the kind of macro environment we've talked about, while really dampening down the downside risk. And that means things like convertible bonds, it means things like higher yielding equities. It also means strategies connected with emerging market currencies, where actually the option pricing makes it very attractive in our view to take positions that are based on the idea that the currencies, those emerging currencies, may rise against the dollar and the euro and the Swiss franc. I think bonds denominated in those currencies I think some of the bank bonds, which are still lagging behind comparable corporate bonds, because I think investors are concerned about the underlying regulatory risk as much as anything else. And I think we feel that that risk is now really beginning to retreat. So I think all of these are interesting opportunities which really combine a degree of upside with more limited downside. And then finally, one can look to some alternative investment categories.